this show on the road. I'm so happy to have you all along with us. My name is Christopher Moore. I'm the the Chief Marketing Officer of Quiet Light. Do all things digital content and marketing, that sort of thing. So very happy to be part of this AMA. We've been doing these for the fall, AMAs and webinars. We've been very happy with how they've come along, and we want to continue to provide content like this. So we hope that you find it useful and enjoyable as well. If you don't know, Quiet Light helps entrepreneurs build, buy, and sell their businesses for 6, 7, or 8 figures. Big part of what we do is educational. We speak at conferences. We do virtual events, webinars. We even have some social events, stuff like that. We do a lot of writing. We put together coursework. We just re-released a course that Mark did on our website. Very happy to share that. And really, what we want to do is help founders, entrepreneurs, whether it's e-commerce, SaaS content, to identify and reach their exit goals, to treat their online business as their most powerful asset and an engine for them to achieve their financial goals. Obviously, there's big tax implications with that, which is why we're talking today. But we, as a company, were founded in 2006, right, Mark, or 2007?
2006, but it was at the very tail end of 2006. So if you listen to podcasts of me,
founded in 2006. We are entrepreneur-led and entrepreneur-focused. We're going to talk a little bit more about that in a moment. But enough about Quiet Light and myself. I want to talk about our 2 wonderful speakers for this AMA. The first is Shanyn Stewart. Say hi, Shanyn.
Hello.
Shanyn is the founder and master of all things, I would like to say, at Advanced Accounting Solutions. She founded that company, can I say, 25 years ago? She is terrific and a very knowledgeable tax and accounting person. She holds Series 6, Series 7, and Series 63, 65 licenses. She's the author of the 10 most expensive tax mistakes that cost business owners thousands. She's a certified senior advisor and certified acceptance agent with the IRS. And she's received her designation as a certified tax master, which is an awesome title, in 2017. I've always wanted to be a master of whiskey, but no one's offering me that title. So thank you for being here, Shanyn. We're so happy to have you. And our other panelist is Mark Daoust. Mark is the founder and grand poobah, keeper of the keys, keeper of the vision at Quiet Light. Like all Quiet Light advisors, Mark has built, bought, and sold several online businesses. Do you know the number, Mark, of businesses you owned, or like legit business, not just like domain names you've bought?
Well, I mean, domain names. I think going down domain names is more interesting because you see all the crazy ideas that you're like, what was I thinking? Was I drinking when I registered that? No, I wasn't. As far as probably about 6 or 7 businesses, I don't know offhand, that actually had some legs at some sort of some sort.
That's good. So yeah, all of our advisors, I think actually 10 of the 11 have built, bought, and sold. One has only done a couple of those things, so definitely junior person on the totem pole. But Mark is no exception there. He's a sought-after speaker, has authored articles for Inc., Forbes, BuzzFeed, and Entrepreneur Magazine. And although he couldn't get into Harvard, his thoughts and concepts are taught there, and we're very happy to have him with us as well. I think that's like the ultimate revenge, to be like, yeah, you wouldn't take me, but you will teach me. You will teach my thoughts. So thank you, Mark and Shanyn, for being here. And of course, this is our AMA webinar on effective strategies to mitigate your tax bill. And something really important that all entrepreneurs want to know a lot about. If you have questions that you want to ask, drop it into the Q&A box or into the chat window. Happy to have them there. Our first question is just a joking question from one of our colleagues, Joe. He says, is flannel a required Quiet Light uniform? That is certainly not true. I'm not even wearing flannel, it's just plaid. But it is a cold day. I'm in Boston today, even though I'm from Denver, and it's a cold day here in Boston. But yeah, it's not a required uniform whatsoever.
Yeah, because I didn't get the memo.
Right. I'm only wearing it because it's snowing today here in Minnesota, so it just makes sense.
Great. So let's just jump right into it here. Again, people, if you'd like to ask a question, feel free to drop them in the question and answer or into the chat window. We'll get to those in the order that they're received. But I wanted to start off with a very general question, and it's directed at both of you, I think, especially since, at Quiet Light, we help entrepreneurs exit their businesses. So how much should people plan on paying in taxes when they sell their online business?
Shannon, I'm going to say you, since you're the certified tax master, the black belt of the tax world. I want to hear you get kicked off on that if you could.
Well, I think one of the things I want to just mention as I start to work with people, I'm an enrolled agent as well, which is actually, you always hear about CPAs, but you never hear about enrolled agents. And enrolled agents are the only federally licensed tax professional in our country. So we're licensed right through the Treasury Department, and we are America's tax experts. So if you run across an enrolled agent, you know that you have a tax expert. So as you're looking at the different tax professionals, but when we're talking about how much should you pay in taxes, the least amount legally possible is always my answer from that standpoint, because there are many caveats within the IRS code that actually allow us to legally mitigate your taxes on the sale of a business. And most people don't even know that.
Shannon, do you know how many pages the tax code is?
Well, the first 9 define income, and every other page after that is all about a web of exceptions and preferences and so forth. So, and it's changing, it changes every year. However, there's some tried and true things that never really go away, because those that understand the code are not going to actually erase the things that benefit them the most. So a lot of the concepts that we actually employ have been around for 100 years. So like installment sale, those types of things. They've been in the code for years and years and years. They're not going anywhere, knock on wood, because they help those individuals that are buying and selling businesses on a huge corporate level as well. But it doesn't matter the size of your company that you're selling, you can use these strategies.
If somebody doesn't use these strategies, Shannon, Chris, I'm going to jump in with a question here. If somebody doesn't use a tax mitigation strategy, and I've heard that before too, which is why I asked, right? The first 9 pages are what you owe in taxes, and the rest of the tens of thousands are how to not pay those taxes, which I think is, I mean, it's funny, but it's also true. But if somebody doesn't employ tax mitigation strategies, they have an S corp set up. What's a typical sort of expectation? Where's our bar here that we're going to hopefully reduce through good strategies?
Right. So best case scenarios, it's just capital gains and your state tax. But if you have depreciation and you have to recapture depreciation, that's ordinary income. So right now, 37%. So when I'm looking at someone and they're coming to me from a standpoint of no planning whatsoever, you're going to lose 45% off the top. If you're in California, New York, you're more like 50 to 55%.
Is that depreciation just on the just on, like if you purchase a business and you're depreciating that purchase price, or is it on equipment purchases, everything in the business?
Right. So it's anything that's depreciated as far as equipment, buildings, those types of things that are on that depreciation schedule. So what I always tell individuals is pull your tax return, look at your depreciation schedule, see what your accumulated depreciation schedule has been for the life of your business. That's going to have to be recaptured at ordinary income tax. And most people, the deal looks really good on paper, and then because they're thinking, well, I'm just going to sell and it's just capital gains, no big deal. And then when they start to say, like, okay, now I've got to look at depreciation and I've got to look at my state tax. And if you're like in New York City, you're looking at New York City tax. I mean, you have all of these moving components. So oftentimes a deal will look really good on paper, but when we start to add in taxes without planning, it doesn't really make sense.
Right. That's fascinating. The recaptured depreciation is an interesting aspect of it for sure. And I think, at Quiet Light, most of our deals that we do, they're asset sales, and we typically have those allocated 100% towards goodwill or towards long-term capital gains tax treatment, right? So you're looking at what for that? You're looking at 22% in that range when you check it out at the federal level only, not necessarily state level. And usually, because we don't have buildings, or typically no equipment, we don't have a lot of the depreciation, but there are still depreciation schedules. And so you'll take if you have like 100,000 of accumulated depreciation, you're paying ordinary income on that, right?
And here's the thing that I find a lot of entrepreneurs do is they actually, they depreciate their cars. That's a huge one. And so, from that standpoint, so I mean, if you buy a car every 3 years and you've been in business 25 years, how much depreciation do you have? I mean, those things add up. Now, one of the things I also want to mention too, and you mentioned this, is that allocating towards goodwill. So one of the strategies that we use in our planning technique is we can only defer the taxation on what is actually classified as goodwill. So, as you structure the sale, it's really important how you allocate those assets in the sale, from that standpoint.
Yeah, let's jump into that actually. Let's jump into the allocation of the purchase price, unless there's any open questions out there, which I'm not seeing any at this point. But I think this is a document that's really important to understand both on the buy side and on the sell side. It's a key piece to most purchase agreements. Quiet Light, our templates and everything that we do, it typically is one of the exhibits. And the allocation of the purchase price is basically saying buyer is going to send over $1 million, and we're going to divvy that $1 million up to these different assets within the business. And it can be the domain name, source code, contacts, and then this very kind of murky concept for most of us that don't live in your world, Shanyn, of goodwill. Can you explain the asset allocation agreement? Where does that actually come home to roost for the buyer and the seller? When does that document become, oh, this was a really important document in this process? And then, once we get through that, maybe barring any more pressing questions, I'd love to get into strategies on both the buy and sell side for that document.
Well,
So what is it?
What I like about Quiet Light is you actually talk about it and bring it to the forefront, and it's in your exhibit. Because oftentimes when we're going through the process of a sale with a client, it's like the last thing people think about. I mean, literally, we went through a deal recently, and it was a software company, and it was like a $150 million deal, and it closed, and we still didn't have a finalized allocation.
Are you kidding me?
But
they have that. My first sale, when I exited my first company, by the way, the moment that I learned about an asset allocation was when I brought it to my tax professional. She said, okay, well, how's this allocated? And I said, what do you mean? She said, well, you have to know how it's allocated, and you and the buyer need to agree on this allocation.
Yes. It was something that the due diligence team just really was not focused on. So it's really important to understand the allocation. So for instance, when I'm looking at the allocation, the first thing I want to do is what can I put towards goodwill? That's really when we're looking at the allocation. Now, there are going to be some certain situations where there's not a lot of wiggle room. There's a lot of, for different reasons. However, the more that I put through goodwill, the more planning strategies I have, from that standpoint to actually eliminate or defer those taxes in the future.
Awesome.
But
All right.
It's a consideration. It should be talked about during due diligence, in my mind. That's where, it should be something that is really discussed and kind of brought to light so that it's fair for both the buyer and the seller.
What are some elements in that? We have goodwill that we can allocate towards. What about like a non-compete? I've seen allocations towards a non-compete. Is that taxed as ordinary income, or is that also cap gains?
So from that standpoint, to be capital gains. Now, again, on the tax strategy, though, we're not going to be able to, let's say, for instance, you're selling your company and we want to defer taxes. I would look at that non-compete clause from the standpoint of, if I am going to receive a monetary value for that non-compete clause, then that means that I can't defer those taxes. I'm going to have to absorb them at the day of sale. So from that standpoint, that allocation becomes very important. And maybe it's only like 1% or 2 or 3% of the overall deal, but that's where all of these little nuances become so critical.
Right. We do have a question. Chris, do you want to go ahead and?
Yeah. Thanks, Maine, for sending this question. It's he has an Amazon PL business, all inventory, no other assets. Had the business for years. On a sale, would the proceeds be taxed as long-term capital gains, 15% or ordinary income?
Okay,
this is right back to our question, right,
Yeah.
Shanyn? It's how you allocate it. And first of all, long-term capital gains. Correct me if I'm wrong, Shanyn. 15% was what we had now 6-7 years ago.
Yeah, yeah,
It's no longer, right?
correct. So we're at 20% capital gains underneath the current tax code. And then, of course, that's just federal. Then you have state and local from that standpoint.
Well, 20%. I've seen some at 22% or 22.5. Am I thinking a little old here with that?
So here's the situation again from the standpoint of the overall sale. The net effect is going to usually be around 20%. So it can be higher, especially if you're over 250,000. Then you're going to have the an additional 3.9% factored in there as well.
Additional 3.9%, and then income, your personal income, does that impact your capital gains?
It does. Correct. Exactly. So you're never. I mean, because we can have 0, 10, 20. I mean, you're not going to. No one selling their business is going to not pay any type of capital gains. The average is going to be about 20. Okay.
That's helpful. Hopefully people understand here, answering the question that we opened up with, Chris, it's a loaded question, right? How much am I going to pay him when I sell my business? I don't know. It depends on a lot. So Maine, for your question is to the, how much are you going to be paying? Again, most Amazon FBA businesses that we sell are going to be taxed at long-term capital gains tax rates that we see, assuming that there's no additional strategies to mitigate that. And where the effort and the work is going to be done is in that asset allocation agreement that comes in. I know Joe Valley, my business partner in this, he makes a point to have that negotiated even all the way up to the LOI portion. So before we get to the purchase agreement level, because the tax treatment for the buyer and the seller don't necessarily always agree, right? So a buyer might look at this and say, I want a different allocation for this because I want to have a more favorable tax situation, but that has a negative impact on the seller. Shanyn, are you able to comment on that a little bit on the buy side? My understanding is you buy a business for $1 million, you can depreciate that over, is it 15 years? Is the depreciation schedule, but there's also ways to maybe expense part of that purchase price rather than depreciate it, expense it right away, or maybe over the first few years. Am I off base on that?
You're correct in that standpoint. Now you're talking, that's not necessarily always, we're always looking for fair and equitable on both the buy side and the sell side. We very rarely see stock sales go through.
Right.
I mean, from your standpoint, I don't know if that's what you, I'm assuming that's what you see as well. They're most asset sales because that's what's better for.
Yeah, well, absolutely. Most buyers don't want to do stock sales because of the liability, right? They're taking on the liability of the company. But where I've seen other, well, let me bring up a real scenario for you that somebody tried to do. And I looked at it and I said, guys, this smells bad. I would contact a tax professional about this, was allocating part of the purchase price to software. Okay, so by doing it to software, the buyer said, it's like I'm buying software. I don't depreciate my software purchases. I expense them right away. And the seller is saying, I built this software and I'm selling this as the asset that I built. So therefore I have long-term capital gains. Now, again, just so everyone follows, the buyer is looking at this saying, I'm buying the software for $1 million. This company is making $300,000 a year. I'm going to carry a loss of $600,000 in that first year because I made this mega purchase, and I get to carry that loss forward for the next several years, get a really favorable tax situation. And the seller's happy because they get a long-term capital gains, and you're shaking your head saying, somebody's going to jail.
Well, so that's a great, so I do tax resolution. Those are the kind of people who knock on my door who are now being audited, and now I have to defend that position, through tax court, so that is something that from that standpoint would be a no-no. And I think any tax professional that would touch that would, any tax professional should be saying that's not legitimate. Software is not an expense, that we can just write off and carry forward losses on it. It is going to be, it's the asset of the business. That is the business, because without the software, where is the business?
Yeah, I would agree. When does, I don't want to go down the rabbit hole because we're talking about selling businesses, but when does buying software become something that is expensed versus depreciated?
Well, so for instance, if you're, okay, I'll give you an example. I have an accounting firm and I buy tax software every single year. It's renewed every single year. That's an expense. Okay. I'm not a software company who actually owns software. It's my proprietary product that runs my whole system. That's not something that if it's costing, $100,000 or $100 million, I can't just write that off in the first year. So it's not renewal. Like, is the software renewable every year? Or is it my product? Is it something I created as a proprietary software? And those are all questions that you have to answer from that standpoint.
Right. And I think the other element that kind of comes in play there is if I'm buying a company like a SaaS company, yeah, that's software, but I'm not buying the software for aiding in the purpose of the business. I'm buying the software because it is the business. That's a good point. Chris, we got a couple of questions coming in here.
Yeah, thanks. And again, everyone, if you want to ask a question, go ahead and drop it into the Q&A panel. We'll get to those as soon as we can. Some good ones coming in here, so we'll keep those going. Keep Mark from his rabbit holes. Help us all out here.
Please do.
If you buy a business that's 100% goodwill, how is that depreciated by the buyer?
Oh, Shannon, let me see if I can get that. That's a 15-year depreciation schedule, right?
It is. So, and here's the thing. I've never seen a deal be 100% goodwill. Okay, there's caps that we utilize usually when we're doing tax planning that usually it's 90% goodwill, because we don't want to, again, I'm also looking from audit risk standpoint as well, that there's no such thing as 100% goodwill. There just isn't. So you're going to have a combination. 90% is usually the highest that we go with goodwill that we can substantiate.
Awesome. That's actually good to know. We often see 80% on our side allocated towards goodwill, and then the remaining 20% to things like inventory or inventory domain names, other sorts of assets.
The 80-20 rule of most things in life is a pretty safe and solid kind of rule to kind of go with, is the 80-20. So.
Awesome.
Great. What are some ideas for actions to take today for a future planned sale of a multi-million-dollar online agency? A couple points here. Corporate structure is currently an S Corp. Is it important to change that? And second is that there's no hard assets at sale, some asset allocation ideas. So there's multiple parts to that question. Sorry.
Yeah, okay. And I'm going to pull that question up so I can actually see the question.
It's from anonymous attendee as how it comes up.
That's okay. Okay, anonymous. I think, is an S Corp appropriate or not? Maybe, maybe not. And I don't mean to be vague, from that standpoint, because I don't know all your other moving parts in your personal life, because sometimes the C Corp strategy makes sense. Now, if you are starting an agency and you were not going to sell for 5 years, I would say maybe a C Corp strategy and using 1202 stock sale would be a really, a viable, planning tool. But if you're already an S Corp, from that strategy, it would probably behoove you, if you're going to sell in the next few years, just to continue to be an S Corp. Making sure that you're taking reasonable salary and that you have everything is actually on your balance sheet properly. And I think, Mark, you can talk about the fact that having clean books through due diligence is critical.
Yeah, we could talk all day about that, but I won't. But we'll just say have clean books. I do want to tack on this answer real quick here, and I want to get to the asset allocation ideas. This process here of planning the tax treatment of your sale isn't something that's done quickly. It takes some time. And so I know, Shannon, you're being put in a difficult spot of having to answer some of these questions with some definitive results. And I remember running into this problem years ago when I asked another tax professional for the purpose of an article, what's the tax treatment? And he gave me what amounted to a written out tree diagram of, this is what it looks like. The actions to take today are, and this is going to be a pitch for you, Shannon, and it's, to the attendees that wasn't the purpose necessarily to teach, but it's a hire professional is the action to take today to find out what your current tax situation is. How are you currently set up? As an S Corp, that's good to know. But as you said, are you being paid a reasonable salary for one? What are the other elements, and what state are your books in as well? Are they clean, and does that need to happen as well? The changes that you want to make should be planned. Shanyn, I'd love your input on this. I would say a minimum of 12 months in advance to have that idea. What would you say is a reasonable period of time?
And I was going to say 24 months, because
Awesome.
from an audit trail standpoint, I want to see that there's been meaningful change within like the books and records, and that we can actually track it from that standpoint. Like we can have an audit trail. And so when we're looking at things from a due diligence standpoint, I don't want something, well, we got it clean 6 months ago. That doesn't work for me. So I'm thinking 24 months from that standpoint. And the thing that there's a lot of ways when we talk about how, you should have a professional. If you're running a multi-million-dollar business, you should have, a bookkeeper who's well-versed. You should have a tax professional that's doing proactive tax planning for you. You also, if you're looking at selling within the next 24 months, I would think that you would actually probably bring on a due diligence team to see what's clean or not. Because a lot of entrepreneurs, and I don't know, Mark, I'm sure you see this, Mark, like I look at someone who's getting ready to sell and they're paying for their car and their cell phone, and like their books are pretty muddy. Like a lot of their personal expenses are running through their business and everything is commingled. And so we really need to find a place where we're not commingling personal expenses with business expenses. Also, there's legal ways, like we institute something called an accountable plan with all of our clients. So there are legal things that you can actually write off through your business, but let's do it the legal way and not just, I use my Costco credit card for all my business and all my personal stuff. I think those are the things that really, as we're moving into a sales situation, that we really need to pay attention to.
Yeah, and with that, I know we're getting a few additional questions, which is awesome. Thanks, guys, for bringing those in. But with that question, as far as where was I going with this? I completely lost my train of thought. A multi-million-dollar online agency. You mentioned having a good bookkeeper. Let me actually make another pitch. Hire a CFO, a fractional CFO for your company. If you're a multi-million-dollar company, your company needs that level of financial analysis. You mentioned at the beginning of this, Shanyn, the idea that when you sell your company, if you're depreciating, assets in your company, you're going to be recapturing that, or that accumulated depreciation is going to be recaptured as far as income. Most of your accountants, if they're halfway decent, are probably trying to mitigate your taxes. They're probably trying to reduce that. And so they're thinking, I am doing you a favor by depreciating that computer that you bought, that desk that you bought, whatever that might be that's on the books, that they're finding ways to depreciate some of the assets that your business owns without realizing or having an eye towards that exit of you have this accumulated depreciation, which is now going to be recaptured. And that exit is not just a flat up 20%, 23%, whatever the number might be, plus your state tax bill. So this is my pitch to say, if you're a multi-million-dollar agency, level up, get an outsourced CFO, let them know that your plan is 2 to 3 years down the road to sell, so that the books can start having that in mind. And then also look at having a tax professional look at the situation. And I don't want to bury the lead here as well, Chris, just time management. I've done a podcast with you, Shanyn, and I know that you're sitting on a number of awesome tax reduction strategies. I would love, Chris, for the last 15 minutes of this AMA, to really, if we don't get to it before then, to really just focus on some of the ideas she has for reducing the tax liability, if that's cool.
Yep, absolutely. Anything else that you want to say on that, on steps people can take today? Okay.
I'm good.
How is original content classified, say for an online training course?
Well, so basically from that standpoint, it's going to be, in my mind, and Mark, I'm not sure, I would think it is going to be an asset that's going to be depreciated.
Same here. Content sites, we would typically, again, 80-20, but we would look at the content as being valuable in and of itself, right? So you've written something, you've created something, that content has value. So I might actually just value that content at 20% of the purchase price.
Great.
Nice and simple.
super simple. And as always, guys, if you have questions, type them in. We got a few more in line, but keep typing them in. We'll get to as many as we can. Next one's kind of a little bit longer one, so bear with me as I read through it. James writes, the question is around qualified small business stock and establishing a new business or restructuring one that they plan on acquiring as a C Corp, so it can be recognized as a QSBS. His understanding is that if they hold the C Corp, a QSBS for 5 years or more, they can still sell that business and pay no capital gains on the gain. If they sell in less than 5 years, they can use a taxable amount to acquire a new business within 60 days, then retain that gain and eventually pull that amount out of for 5 years, holding the new business. Are you familiar with this strategy? Would you recommend it when rolling up a new entity?
Okay, so here's, I love 1202. That's section 1202. I love it. Now here's the thing. Just to bring clarification, first of all, the company has to have been already established as a corporation, taxed as a C Corp right out of the gate. Basically, what that means is you can't take that old LLC that you have lying underneath the couch and file a form 8832 and then say, and elect to be a C Corp. It has to be a C Corp right out of the gate. You had to have acquired that stock directly from a corporation itself in its original issue. So, it has to be original stock, not dirty stock, from that standpoint. The company has to be under $50 million capitalized. Now there's companies though that are excluded from this. So you got to kind of look and see if you might be excluded. So a service business in health, law, engineering, architecture, accounting, actuary, performing arts, consulting, athletics, financial services, banking, insurance. I mean, there's a list of people who can't utilize 1202. So then that's my next question. Can you actually utilize 1202? So there's a lot of technical requirements to see if you qualify, because most businesses won't from that standpoint. If your business is a patent though, like you have patents or copyrights or trademarks, you could use a 1202 from that standpoint. Let me see what the other components of this question. So you can't restructure. I mean, you got to be a C Corp right out of the gate from that standpoint. You got to hold it for 5 years.
Shannon, what about in the case of an acquisition? Somebody buys an S Corp, they're setting up a new C Corp.
If it's an asset sale, yes.
Okay.
If it's an asset sale, yes. If it's a stock sale, no, from that standpoint, because remember, you're acquiring the same footprint of that old company, and then from the standpoint of if we sell less than 5 years, but use taxable amount to acquire a new business in 60 days. Again, I'm going to have to look at that one. I mean, you can reach out to me and we can research that a little bit more. I know that there are planning techniques that allow it. I've never seen it actually work. So there's one thing to have it on paper from the standpoint of it looks good on paper, but does it actually work or see it work? I've not seen it work in 25 years. So.
Okay.
I don't
Chris,
know.
don't you dare ask me to try and answer that question.
Well, I do have one. That's good. I'm not going to ask you that one. I do have one for you. We're talking a little bit about some unique deal structures, stuff like that, in order to reduce your tax burden. Does that impact someone's ability to sell their business? I mean, does it reduce the number of buyers to try and get one of those creative, deal structures?
Yeah, anytime you try to force the tax structure, actually, let me back up. There's kind of an understanding as to the tax structure that people are going to use for these transactions. We don't often run into arguments over tax allocation. It happens. We have actually, I can think of one deal off the top of my head that fell apart because it wasn't discussed early on, and the allocation made the deal not worthwhile for the parties. So a lot of time was wasted. If you're coming to the table with a really specific deal structure that you need, it can cause some friction in a deal. What comes to mind would be like a UK transaction. UK in the past has had what they call entrepreneurs relief for stock sales. So there, in that situation, 10% was the effective tax rate if you were selling a UK company under a stock sale. Conversely, if you were selling a UK company as an asset sale, that person would be paying upwards of 50% in taxes, effective taxes. Well, naturally, they want to pay 10%, but how many US buyers are interested in acquiring the stock of a UK company and running a company in the UK, right? It limits that buyer pool pretty quickly. And so UK companies have historically been difficult to sell unless we have somebody willing to go through that. And I went through that exercise last summer, in which we had a very complex structure to be able to get everything worked out, and honestly beyond my expertise in this area. Any of the other elements that we get into, and Shannon, again, I want to make sure that we have time to talk about some of these things. They're all fantastic when we start to get into it, as long as it doesn't put an undue burden on the buyer. If it puts an undue burden on the buyer, or more importantly, I guess, if the buyer then is in a less favorable tax treatment, that obviously that's going to cause problems. But if there's other burdens or requirements on that buyer, that can have a negative impact on the sale and just restrict a buyer pool, or just have somebody not willing to pay as much, right? Because it's just not worth the hassle.
Anything to add to that, Shannon?
No, I just think, whenever we have helped facilitate the sale of a business, it's all about making it fair and equitable on both sides of the ledger. So
yeah, it's got to favor both people. I have a question, Shannon, for you that deals with financing the purchase of a business. And now when we talk about financing, again, seller financing specifically, it's obviously a loaded question, because we have lots of different types of financing. There's straight up financing saying, I'm going to pay $1 million, $200,000 is going to be paid over the course of 2 years, in single $100,000 installments. We have stability payments, which is the target is $100,000 after 12 months, every 12 months, but it can be escalated or de-escalated. We have straight up revenue shares. We have binary payments, which are, if you hit this goal, you get the payment. If you don't hit this goal, you don't get that payment. So they can be cut up in a lot of different ways. Now I'm going to ask the overly simple question. When does that get recognized for tax purposes?
When you receive the money.
When you receive the money? In all cases?
Not in all cases.
Okay.
Not in all cases. Again, we're dealing with a tax code. So the first, yes, no, maybe so. So when you're talking about receiving installment payments, so an installment sale is just something where you basically are receiving payments in equal installments, and it gives you the ability to actually usually defer the capital gains until the very end. In some cases, not in all. In depreciation, like if you're recapturing depreciation as part of that installment sale, you're going to pay the taxes then on the recaptured portion of the installment piece that you're receiving. So that's why I said you might, not have taxation till the end, but you might have some now. It's never just cut and dry from that standpoint. Now, having said that, when we're doing planning, one of the things I usually find is that my buyer wants his money up front, usually from that standpoint. Now, there might be earnouts that we see. So when we have a buyer that wants substantially all of their money up front, an installment sale might work for a portion of it, or even a structured sale. So just like what you're talking about, where you negotiate a traditional sale and then you're getting so many payments or earn out over time, kind of like an annuity from that standpoint, which is great because you're getting a return of your original basis and you're not paying taxes on that. And then you have the capital gains portion of it or any interest. So it can actually be layered types of taxation on the sale of a business as well.
I think that might be a good segue into talking about some of the tax mitigation strategies. And I would like to bias somewhat towards the sell side. Obviously, I agree with you 100%. It's got to be equitable because if it's not, your buyer's not going to do the deal. So you can't ask them to pay twice as much in taxes just because you want to get a better deal. But I'd love to get into some of your some of your strategies, common strategies, thinking again in mind of the internet business owner, right? Very asset poor in terms of hard assets, usually just inventory if it's an e-commerce business, maybe light equipment. What are, I'd love for you to get into, again, just some ideas or ways that you know of to reduce that tax burden on their side.
On the buyers, on the seller side.
On the seller side, yes.
Okay. So, it all boils down to planning from that standpoint. Okay. So one of the things that we try to do is either we try to defer the tax or we try to eliminate the tax. And when I say eliminate, people are like, is this legal? Can we do this? There are ways to legally eliminate taxation. One of the most sought after planning techniques that we use is actually coupling an installment sale along with a monetizing loan. So in an installment sale, somebody actually basically you're going to receive equal payments of the purchase price of your business over an equal period of time. And sometimes that can be like 2 years, 5 years, even as many as 30 years from that standpoint. And you basically are kicking the tax man down the road with that. But the problem is you don't have all your money up front. And so if you don't need all your money up front, an installment sale works just perfectly. But oftentimes my entrepreneurs want their money up front so they can invest in a new business or go off and retire and so forth. And so we've got to get the money into their hand. And the way that we do that is we actually structure what we call an installment sale with coupled with a monetizing loan, where they actually get a monetized loan up to 93.5% of the purchase price up front, and we defer the taxation for 30 years. So at the end of the 30-year period, the sale is actually, it's recorded as an installment sale for 30 years on a tax return. In the final 30th year, it's recorded as a sale, and that's when the taxation is actually calculated. So we're using the time value of money in this kind of strategy so that you're having all of your money up front to utilize and to invest. We actually go forth and we actually show them how much they need to invest to pay the taxes in 30 years so they can segment that in their portfolio or what have you. So it's just a kind of a clever strategy that individuals use to leverage their company for 30 years without paying Uncle Sam.
So
30 years.
Let me just get this straight here. In that scenario, again, using the nice round number of $1 million, I get all that $1 million, but I don't owe the taxes on that until you're 30.
Yes.
Because what I've done is I've taken a loan for 93%.
93.5%, yeah.
Thank you. 93.5%. And then the installment payments are going against that loan. Is that correct?
So no. So what happens with this is a situation where your buyer has come to you, and let's say it's $1 million sale. They have $1 million, and so your buyer gives $1 million, and you're going to actually get 93.5% up front because we have a third party intermediary inside there. Okay. So the way that this really works, just kind of, and I'm trying to be aware of the time. So we have a situation where we negotiate the sale of a business. And when it comes to close, we bring in a third party, unrelated third party in exchange. Your buyer grants the lump sum sales payment to the third party dealer. That dealer then gives you a monetized loan for 30 years. The loan is non-recourse, meaning they can never come back and get it from you. It doesn't go on your credit report. It's all a private transaction from that standpoint. At the end of the 30 years, and there's interest being paid and so forth, so it's all legitimate underneath IRS guidelines. At the end of the 30 years, you simultaneously pay back the loan from the dealer, and then the loan is then paid in full, and the transaction kind of unwinds from that standpoint. But here's the caveat to this. I mean, I think this is what's important to understand is the pushback I get from this strategy is, well, I don't know what capital gains is going to be in 30 years.
That was going to be my next question.
Yeah. And it always is. But here, in my mind, this is the real magic here. It isn't so much about the tax deferral. It's about time value of money, and it's about inflation. So you've got to understand both of those key points. So basically, I don't know what capital gains is going to be in 30 years. Okay. I don't know. What I do know is that I know what your tax bill would be today, and I know what inflation has averaged. So let me give you kind of an example. If inflation continues, let's say at 2.5% over the next 30 years, and that the long-term capital gains rate stays at 20%, the tax bill on a $1 million transaction today, okay, the tax bill in 2050, yeah, that's 2050, 30 years from now. It sounds weird to say 2050. It'll be about $94,000. So about 10% of the $1 million. Okay, that's less than half of the bill that it would be today. Now, even if inflation were to spike into, like it did in the 1970s, you still have been able to use those funds for 30 years. So it's not just about how much am I saving in taxes, it's about the time value of money. It's about, the eighth wonder of the world, compound interest. And it's about, inflation, how that erodes away our purchasing power. So it's going to erode away that tax bill 30 years from now as well.
Right. Somebody asked what the interest is on a loan like that.
So it actually, it's going to depend on several factors because of lending and things of that nature. So here's the way you look at it from this standpoint. You don't actually pay the interest. You do pay it from an escrow account that's already been set aside by that 6.5% that you're giving up on the front end from that standpoint. Okay. I know that another question came in if someone passes away before the 30th year. So here's what we usually do in our planning from this standpoint. We normally show you right away, the loan does not monetize for 30 years. So your estate holds that loan for the rest of the 30-year period. Now, I have some people are like, oh, I don't want my wife or my husband or my kids to have to worry about it. What we do then is we actually purchase a life insurance that usually it's a cash value policy. So it's building cash value. So if you never use it, great. If you do need to use it at your death, you can go ahead and pay those taxes at that period of time as well. So we try to build in, I'm always like, what's plan A, plan B, plan C? I don't like when a plan doesn't come together. So we try to make sure that we always have a backup plan from that standpoint.
Gosh, yeah. One thing I love about working with financial planners is just the levels of planning that goes into it, right? It's always mind-blowing when you see the different tools being used in concert with each other. I want to go from what I consider to be complex, I consider that to be complex because it's a different structure than we typically see, to something simpler. Joe Valley sent this to me directly through chat, and it's a question we actually run into all the time. It's November 12th today. We have deals that are going to go under LOI today that are going to close right around the end of the year. For tax planning purposes, what does receiving the money mean? So I sign my purchase agreement. I'm the seller. I've sold my business for $1 million. I signed the paperwork on December 27th. The money is in escrow, but I don't want to receive the money till January 1st. Does it make a difference when I receive the money? Or in what year am I going to have to pay that money? Since we're talking about time value of money, we'll get 1 year.
Well, so here's the thing. It's called constructive receipt. Constructive receipt refers to the situation where income can be used despite the fact that the money's not physically received. So from an accounting situation, it does not usually apply in accrual accounting, but in a cash basis, from that standpoint. So an individual is considered to be in constructive receipt of income when they have the ability to control or utilize funds, even if they don't have direct possession of it. So that's, you've got to look at it's kind of like the same way when my business owners say to me, oh, I've got $100,000 check that I received in December, but I'm not going to deposit it into my bank until January 1, because I really don't have it, right? Well, constructive receipt would say you had control of that money. So do you have control of the business on December 27th?
Do you have control of the business, or do you have control of the funds? Because if the funds are being held by the buyer or by the escrow agent, upon release from the buyer, who has that constructive control?
So from that standpoint, basically, you can't pay taxes on anything that you don't have control of. So again, it's a legal standpoint of who has control.
The escrow agent, in
the
theory.
escrow agent. So from that standpoint, then constructive receipt may not have been actually, transferred, but a revenue agent is going to make the argument that did you have control over the business from that standpoint? I mean, you've got to be able to back up. So if it's in how you're written in your agreement, from that standpoint, again, if you're accrual accounting, it doesn't matter. If you're a cash basis, the doctrine of constructive receipt stipulates that the receipt of funds by an agent is considered to be received by the principal at the time as well. It's sticky.
One more argument going right up for the accrual basis accounting, huh?
Because you could always elect to be cash after you get through the sale of the business, right?
Right.
Always do a change of accounting method. So let me say this: if the money is in escrow and if your agent does not have full control, and I think that's something that Joe is pointing out, in escrow, if you don't have full control, then there's not constructive receipt. Again, it's about what control does your agent have at the time. So I think that's being clearly defined, and as long as you can clearly define that, then you can say, okay, you're not receiving the monies until the 2021 tax year. So again, it goes back to the definition of all of those acting roles.
It's amazing. They have 80,000 pages or something like that of tax code, and there's still murky areas. I think we need to add like 5 more pages to clarify that. We have like 6 minutes, and I was hoping we could get to one more tax mitigation strategy if you have time for it. And I'm going to say maybe dealer's choice, or if I'm putting you on the spot, what about like a charitable trust?
Yeah.
So
So here's the great thing about so any type of charitable strategy. First of all, we need the most lead time to plan for a charitable strategy, because if you have a letter of intent, then we can't do a charitable strategy, period. Okay. State law is very specific about that. So you can't have an LOI in place but if you want to use a charitable strategy. But a charitable strategy is an elimination method. We can actually eliminate income taxes utilizing a charitable strategy. Couple of things to keep in mind: we can't have debt on the business. There could be no debt in a charitable strategy. And you have to be willing to take your payments over a period of years. And one of the things I see a lot of them out there is that there's a lot of people who are financial advisors who offer this kind of exit planning, and their fees are really high. So you've got to look at the ongoing fees of actually utilizing the charitable strategy over the course of the 5, 7, or 10 years that you're utilizing the strategy. But basically what you're doing is you are giving your business to a charity, usually a charitable trust, and then that charity is selling the business. And charities that are 501c3s do not pay taxes from the sale of appreciated assets. And so that's where that whole tax code comes in from that standpoint. And then once all of those assets are inside the trust, they give you an income. Sometimes it's a lifetime income, sometimes it's a 10-year income, but the income starts to be derived from that charity, with the proceeds being left to the charity and at least 10% of the sales price going to the charity as well. So it's a great method if you're charitably inclined. And a lot of people are, and a lot of people don't need all of the funds up front because you can't get all the funds up front. So it's a really great way to eliminate taxes and fulfill your legacy as far as a charitable donation as well.
That's awesome. Chris, we're up against the clock here, aren't we?
Yep, we sure are. I mean, if you have any final thoughts, I'd like to hear those, but I'd also like to give people an opportunity to know how to reach out to you, Shanyn, or to reach out to you, Mark, if they need, more, thoughts on exit planning specifically, or Shanyn, more thoughts about tax planning specifically. So Shanyn, how can people reach out to you if they're interested in more information?
Right. On advancedaccounting.com, there's actually an icon where you can schedule a free consultation, and I'll spend a half hour and I'll actually look at all of your financials and your tax returns and let you know my thoughts on how to, mitigate taxes legally.
Terrific. Mark?
Well, you guys hopefully know where to reach me, Quiet Light Brokerage, mark@quietlightbrokerage.com. I love working with people like Shanyn when we have that lead time for an exit, because when it comes to the sale of your business, it's not just the money that you're getting at close, it's the money that you have to pay out as well. And Uncle Sam likes his share. So whatever we can do to reduce that through proper planning is something that I love to do. And hopefully people like Shanyn, you add a lot of value to the transaction. So thank you, by the way, for coming on. I think you've shown your black belt in tax planning on this call pretty impressively.
All right. Well, thank you everyone for joining us. Thank you for your great questions. We'll be doing more of these AMAs and webinars in the future. You've got information how you can reach out to both Mark and to Shanyn. We've got a lot of great content on our website, on our YouTube page, so check those out. And if you ever have questions about planning your exit, which should be you should be starting at least a year in advance, please feel free to reach out to any of our advisors through the website, and we'll be happy to help you out. So thanks everyone for joining us, and we will see you next month for another AMA. Say bye, everyone.